Hi, my name's John. Welcome to Investars. Invest like a boss. So like any good business endeavour should start, we thought we'd kick today's session off with a coffee. So as a team we got together and we wandered across Seymour Square over to Starbucks. Other coffee shops are available. We meandered through the tables and were greeted by a young gentleman who said to me, "Sir, what can I get for you today?" So I looked up at the menu board and I was overcome by a sense of hopelessness. What coffee did I want? Did I want a cappuccino, a frappuccino, a mochaccino, a latte, a corso, an espresso? How hot did I want my coffee? What coffee bean did I want? Did I want a takeaway cup? Now I knew the outcome I wanted to achieve. It was kind of a medium coffee with some milk in. But the 87,000 varieties of coffee on offer at Starbucks were simply overwhelming for me. Now choice is good. Choice is a really good thing to a point. But too much choice can have some negative connotations attached to it. Stress and anxiety about making a decision, delaying making a decision. And once we've made that decision, feelings of regret and anxiety. Did I choose the right cup of coffee? Now over the last 50 years, for us as investors and consumers of financial products, the number of investment options has increased by 45 times. So it's a real challenge to select investments and put them together in a portfolio. But that's the challenge you guys are going to take on as part of the Investars investment educational program. So there's some keen investors amongst you. So we'd like to give you a virtual 100,000 US dollars. And your challenge is to build a well thought through, well considered investment portfolio with that 100,000 US dollars. To make it a fair game, there's going to be some rules. So the minimum number of funds you can invest in will be 4. The maximum will be 12. The maximum allocation to one particular fund can be 40%. Because we don't want you to just pick one fund and hope that's going to be the best performing fund over the duration of the game. Now we're going to be looking at the performance of your portfolios in US dollars. So you can invest in funds based in other currencies, sterling, euros, Japanese yen, but we're going to be considering the performance of your portfolio in US dollars. And the winner of the game is the portfolio that grows the most over the duration of the Investars investment educational program. So best of luck building your portfolios. I'd like to talk to you through some key considerations to think about over the next couple of months. So I'd like you to think about how you would drive. If you're driving down Shakeside Road, maybe you're a little bit like me, and you sit in a slow lane, below the speed limit, and it's going to take you quite long to get from point A to point B. Often we call asset classes and funds investment vehicles because they do exactly that. They get us from point A financially to point B. So maybe you're like me, you sit in a slow lane, slow and steady, it's going to take you a long time, but I'm actually taking on less risk driving that way. I've got a nice amount of time to see if there's a crash ahead of me, I can react. Or maybe you drive in the middle lanes where you can go a little bit faster sometimes, a little bit slower. Well, you get to point A to point B faster than I will, but arguably taking on more risk in doing so. You've got less time to react to a crash ahead of you. Or maybe you go in the fast lane. You put the pedal to the metal, you go as fast as you can. You've got the potential to move from point A to point B extremely quickly, but in doing so, taking on more risk. Your reaction time is significantly reduced. So if there's a crash ahead, it's going to be tougher to avoid it than me. I'm sitting in a slow lane. So, like driving, with investing, it's important to think about how you drive. Your speed, how fast you want to go from point A to point B, and the risk that you're taking on in doing so. What's important is not also how you drive, but what you will drive. Now, asset classes, like everyday transport vehicles, have traits, have characteristics that make them different. We've plotted 4 of the key ones here on a chart that shows risk versus return. You see there's quite a linear connection there. The more risk you take on, the more potential for return. So if you think of an asset class like cash, an asset class you're probably quite familiar with. It's very low risk, but potentially very low return as well. So if you were to be 100% invested in cash, it would be like driving a tank. Very, very solid, very slow, will get you from point A to point B, could take an incredibly long time. But asset class bonds, which is riskier than cash, but more potential return. Now a bond is a debt instrument issued by a government or a company, and it has a face value, a value in the market, but it also has an income or yield that the issuer of the bond, the company or the government, pays to the investor in that bond. So if bonds were a vehicle, they'd probably be like one of those open back lorries you see driving around Dubai. They'll get from point A to point B quite steadily, and they're real workhorses of the investment industry. The bond market is the biggest and most developed in the world. Big sovereign wealth funds, big pension funds like them because of the risk-return characteristics. Billions, trillions of US dollars are invested in bonds. Well, what about the next asset class? Property. Again, we've taken a step up the risk versus return spectrum. People like investing in property because it's an asset class that's not 100% correlated to other asset classes. Meaning if there's an event in the world, it's affected in slightly different ways to either bonds, equities, or cash. Now, if property were to be a vehicle, it might be a family SUV, where you can go quite fast from point A to point B, but there is protection there for the driver. There's airbags and safety systems. So not quite as risky as investing in equities, but certainly more risky than investing in cash or bonds. So what about equities? The highest risk, but also the highest potential return. Now equity is part ownership of a company share or company stock. Now equities, over time, reward investors with potentially high returns, but they also carry considerable risk. In a calendar year, they have the potential to fall by more than 40 or 50%, to halve the value of your investment. So if an equity was a transport vehicle, it would be like a motorbike. Incredibly fast, can get you from point A to point B very quickly, but with very, very little downside protection. So I'd like to go back to my cup of coffee. After getting my coffee in Starbucks, I came back to Emaar Square, and I'm confronted by two sets of lifts, two sets of elevators. Elevators on the left and elevators on the right. And there's always a long queue for both sets of elevators. I wonder how different the queues would look if the elevator on the left was held up by one cable. The elevator on the right was held up by 4 cables. I warrant the queue for the elevator on the left would be very short. The reason for that? Well, should that one cable snap, then the elevator is going to fall. But the elevators on the right, they're held up by 4 cables. Should one of those cables snap, there's still 3 cables to support that elevator. It's the same when it comes to investing. This concept of diversification, this concept of not just relying on one type of investment, one type of asset class. It's absolutely key in terms of managing our risk. We don't want to be the elevator relying on one cable that falls, but also creating alternative sources to generate returns. So if I'm building a portfolio, surely it's about just looking at what type of investment has performed really well over the last couple of years and investing in that. Well, you could do that, but in doing that, you'd build a team, a portfolio that looked a little bit like this. So Cristiano Ronaldo, an incredible footballer, scores on average 40 goals a season. So if I was building a team based on the best performing asset class, if I was a football manager doing something similar, building a football team, surely I'd pick Cristiano Ronaldo 11 times. Certainly this team might score a lot of goals if they pass to each other, but how would the goalkeeper be? Would it be a good goalkeeper? How would the defence be? What's the midfield like? The ability to turn defence into attack. Now as an investor, as a portfolio manager, you need to think like a football manager. You need to think in terms of specialist skills like goalkeepers, a solid defence, a midfield players with the ability to turn defence into attack, and then embellishing it with those Cristiano Ronaldo style characters, the best performing asset classes. So we've talked a little bit about risk versus return and the various asset classes, and there is this connection between risk and return. As an investor, if you're adventurous by nature, you're looking for high returns. As a trade-off, you're taking on high risk. A balanced investor, perhaps you're willing to accept less return, but as a trade-off, you're taking on less risk. You've got more defensive style asset classes within your portfolio. As a cautious investor, you're happy with lower returns, but you're comfortable with a lower level of risk. Now, as investors in building a portfolio, what we're ideally looking to do in terms of that diversification and looking at the different character traits of asset classes is keep hold of returns, the kind of returns, equities that can give us, but take risk off the table, reduce the level of risk we're exposed to. And there's a great example here when we're looking at a salesman, a trader. This gentleman here, he's got some money and he wants to sell some stuff to some people. But it's summer and it's England. So the conditions, the weather in which he's selling things is susceptible and very, very likely to change. At some points it's sunny, at some points it's rainy, and quite often in England on a summer's day it can even snow or hail. So first attempt, this guy goes, right, I'm going to spend all my money, all my stock, I'm going to buy ice creams. So if he manages to hit a sunny patch, a sunny day, that's fantastic. He'll sell all his stock and he'll sell all his ice creams. But should that be a rainy day or the weather change from sunny to rainy, he's going to stop selling ice creams because not many people want to eat ice creams in the rain. Likewise, if it starts hailing and snowing, he's going to sell no ice creams at all. So he's concentrating on his risk, he's concentrating in making a play that it will be a sunny day and he's got ice creams to sell. Investor number two, he's a little bit more conservative, a little more balanced. He goes, right, I'm going to split my stock between umbrellas and ice creams, knowing that in England, on a summer's day, on a bank holiday, sunny, rainy, it might even snow. Fantastic. So the sun comes out to begin with and he's selling his ice creams. Remember, only half his stock is in ice creams. But the weather changes, it starts to rain. But that's fine, half of his stock is umbrellas. He starts to sell umbrellas, he doesn't sell ice creams anymore, but that's fantastic. He's still got something to sell, a source of return in his stock portfolio. And towards the end of the day, you know what? It starts to snow, it starts to hail. That's when all the customers go away. So he's spread his risk between ice creams and umbrellas. He's kitting himself out for two market conditions, but not the third. Now the third takes his stock and splits it three ways this time, between ice creams, umbrellas, and skis. So during the course of an English bank holiday, he's got ice creams to sell when it's sunny. His umbrellas do a roaring trade when it starts to rain. And you know what? When it starts to hail and the snow comes out, skiing is the order of the day. So he split his stock three ways. He's more diversified. He has the ability to make returns no matter what the market conditions are. Now granted, he won't sell as many ice creams when it's sunny as the gentleman who's 100% of his stock in ice creams. But the benefit is he has something to sell during all kinds of market conditions. So in our previous session we talked about the importance of having a consistent approach to portfolio construction. That's what I want you guys to really think about. Think about how you feel about risk. How would you drive? The example we previously used. How much are you going to allocate to the different asset types? Maybe you're really adventurous and you're going to be 100% in equities. Maybe you're going to look for a mix of equities, bonds, properties and cash. Thirdly, what areas of the world do you want to invest in? That's what we're going to look at next. So, if I pop up our next slide, very often when I put this in front of investors, I ask the question, can you see a pattern? The answer is, there is no pattern. This chart shows the performance of different markets and asset classes over a number of years. Each one of them is colour coded, so you get this quilting effect. What you see is how quickly asset classes from being the best performing to the worst performing. Now, with the benefit of hindsight, what you would have done is invested in emerging market equities up to 2000, moved into cash, and then invested in emerging market equities again after the global financial crisis. But no one has 2020 hindsight. And as investors, the performance of an asset class up here that's generating nice positive returns for us feels very, very different to the one down here, which is losing us money. Prospect theory states the gratification from the gain is only half that of the pain of financial loss. So what we like to do as investors is diversify, is spread our investment around different markets and asset classes. So we do pick up some of the upside of asset classes, the growth they're generating, and this offsets some of the losses in other asset classes we might be invested in. You get a moderation effect, where hopefully you're running a true and average and median course there through the different asset types. So the question still stands though, which areas of the world would you invest in? What's important is for you guys as business and economics students to formulate your own view. Take a look at what's going on in the world, what's going on politically, what's going on in various countries, which countries are generating positive economic data and news, which are generating more negative news and sentiment. Formulate your own view. But there's lots out there to help you. A really good example is here. This is the Schroders monthly economic infographic, which draws up the key salient points about global economic data and boils them down to a very, very visual format. So over the course of Investors, we'll be bringing in not just Schroders, but some other asset managers to talk to you about what's going on in the world, how they approach investing. It's important for you guys to have your own view and back that up with reasons you've put certain asset classes in your portfolio. So back to our structure and process for building our portfolio. The fourth stage is picking your funds. You've thought about your risk, you've thought about your asset allocation. How are you going to split your 100,000 US up? You thought about the areas of the world you'd quite like to invest in, those that you definitely don't. Now you need some funds to populate your strategy. How are you going to pick those funds? Well, what we've got for you is an online tool, a fund center, that gives you all the data and analysis you could ever want around the funds available with the Investars Investment Educational Program. Let's take a quick look at this. So, first thing is to make sure you're looking at the funds in US dollars. The performance during the game will be assessed in US dollars. It's important to rebase everything back to US dollars. Then what you've got is a wealth of information about funds. You can cut up performance information, look at fund statistics. For example, if I wanted to look at the best performing funds less than a year, I'd click on this tab here. If I wanted to filter that by the best performing funds year to date, so from the 1st of January to today, I click on this header, a little bit like a filter field in an Excel spreadsheet. Then the funds are ranked best performing funds year to date. There's a variety of performance information available to you. There's also longer term performance information. For example, over a year. I can then filter by 5 years and see which funds have consistently performed generated returns over the last 5 years. What's important though is that risk and return are two sides of the same coin. What the Fund Centre does is it gives us the ability to also look at risk statistics. So here we see volatility. Now volatility is what we in the investment industry call risk. It's another term for the wiggle in the line, the up and down movement of an asset class. So it's important not just to look at returns, but also the risk associated with those returns. So you've had a look through the Fund Centre, you looked at returns, you looked at risk, and you're interested in a fund. What do you do next? You simply click on the fund name and you get taken through to what we call a fund fact sheet. Now, a fund fact sheet is kind of a combination between an instruction manual and a school report. Now, the first side of the fact sheet is the instruction manual. There's about 5 key areas I'd like to highlight for you guys. The firstly is the fund objective. That says how the fund invests, where it invests. It's the headline statement as to the nature of a fund, the market invests in, or the asset class. Secondly, the fund commentary. So that's how is the fund doing against its objective? Is it doing well, or what's affecting the performance? Is the outlook positive for that fund and the markets that fund invests in? Over here we've got some fund data. So this is analysis on this particular fund. A couple of key things I'd highlight are the fund size. So larger funds mean more people have invested in them. That's normally a good size. Anything over $100 million is a good size fund. We also see a crown rating here. So between no crowns and 5 crowns. This is an at-a-glance guide to the quality and consistency of the management of that fund. If a fund has 5 crowns, it's in the top 10% funds in its peer group, so similar funds. The final 2 areas are down here. So the asset allocation within that fund. Now this is a mixed asset fund, so it invests across markets, across sectors and across asset classes. And you can see exactly where that fund is investing as at today. And over here, the top 10 holdings within that fund. What kind of companies is this fund investing in? Is it Microsoft? Is it Google? Is it Tesla? So that's the instruction manual part of the fact sheet. The flip side, the second side, is the school report. So this is how the fund has done relative to its peer group. With funds we create peer groups because we like to compare them on a like-for-like basis. It wouldn't be fair to compare an equity fund to a fund that's primarily investing in cash because they've got very similar characteristics and traits as we've looked at. What we like to do is split similar funds up into quartiles. So the top 25% funds are called quartile 1. Quartile 2 is the top 50% and so on and so forth. So here we can see how the fund has performed against its peers, against comparable funds over a variety of time periods, and also graphically in terms of a chart. Now we talk about volatility being the wiggle in the line. That's a good example of it here, where this fund, you can see during 2018, it's been quite volatile. There's lots of up and down movements in its price, in its value. So going back to our structuring process that we think is the core of the Investars investment educational program. So we've picked our funds now. Now we're going to build our portfolio. At this point, I just want to highlight to you guys the rules in the game. So it's $100,000 US, a minimum of 4 funds, a maximum of 12, with a maximum allocation to one fund of 40%. The results are going to be assessed in US dollars, and the best performing portfolio over the duration of Investars is going to be the winner. I wish you guys best of luck. We'll be on hand every week to support you. I hope you enjoy these 2 videos. I look forward to meeting you face to face.